Chief Investment Strategist with CFC Seymour Hong Kong joins us now. Derek, let's start off on Korea just very quickly. Clearly the 75 basis point cut is to help the economy, but isn't it just going to make matters worse for the Korean currency?
It definitely will, and I'm really surprised they cut rates so deeply. In my mind, it either reflects their lack of imagination regarding the detrimental effect on a weakening currency when interest rates are lowered, or a planned move to actually abandon thinking about inflation and even invite further currency weakness, because this will be the only export will be the only part of the Korean economy which may do well next year if they engineer a competitive currency depreciation.
Are you also worried about what's going to happen to inflation in Korea? I mean, I don't know what the latest reading is, but I saw back in September the core inflation rate in Korea was around a 10-year high. So you've got interest rates coming down, you've got a weak currency as well. Do you think that inflation might stay stubbornly high?
Definitely, inflation has to stay high because dollar-won exchange rate is up 55% year to date, and I think it will go up by at least another 10% to 1,600 by year end. So there will be huge imported inflation. The Central Bank of Korea is supposed to target headline inflation, which is on decline, but to my mind, the rate cut today is an abandonment of the inflation targeting strategy and a complete focus on growth, which may be helpful for the growth part, but I'm really concerned that the currency has to depreciate substantially further, no other way.
Indeed, you see dollar won going to 1,600 by year end, Derek. And what about interest rates? Where might they come down to?
Well, if they did abandon their inflation target, then it's feasible for them to cut rates much further. But usually when this happens at times like that, there will be a lot of speculative money betting against the won. And what frequently takes place is the central banks at some point are forced to protect the currency either with massive currency intervention or rate hikes. And given that they have $175 billion in short-term currency debt, close to their entire reserves, I think that they will have to reverse the interest rate strategy at some point to prop up the won.
Oh, certainly some of the concerns that you're throwing out here, Derek, are being echoed by investors in the Korean market. I mean, the Kospi is sinking despite these moves. Where would you see the Korean market going down to before it might form some base?
It all depends on global trends. Indeed, the Korean situation is precarious because foreign investors are afraid that they will lose on the currency as well as on the stock market, but in any case, as long as U.S. equities will fall, so will Korea. And I'm expecting S&P 500 to bottom out only around 750, which is 15% down from now, which would mean that Korean stocks have to fall even further because of the larger volatility here. So I would give them at least another 20 to 25% down.
Ouch, ouch. Derek, you know, it's really interesting, isn't it? I mean, it's not just the Korean market this morning. It's pretty much all of the markets except for the Nikkei, and even that will open up for afternoon trade in a few minutes' time, so we'll see what happens there. But nonetheless, do you find it interesting that the Wall Street was down, but by no manner of means as much as was expected? Remember when it was expected to be limit down before the market opened? So Wall Street wasn't as bad as expected. U.S. futures were even higher this morning, and yet Asia still sinks. What do you make of that?
Exactly. I have to tell you, I'm really surprised by the declines in Asia today. I think the only way we can look at it is that investors in Japanese stocks are reassessing earnings outlook given the strength of the yen, which will really hit Japanese exports. And investors in emerging Asia are becoming increasingly risk averse, which means that risky assets such as emerging equities may fall even if U.S. S&P 500 futures are rebounding. And possibly it's because everybody around the world is trying to come to grips with how deep the recession next year will be. We are looking at 2009 US GDP contraction by 0.7%, Eurozone 1%, Japan 2%. So I don't think that the markets are fully pricing in such depressing levels of economic activity. And if our forecasts are correct, stock markets around the world have to fall further.
They have to fall further. Very quickly, Derek, what strategy would you be taking?
I think we still need to go long the yen and short ends of the G3 government bond curves. There's no other way until equities stabilize. Also, I would be long the dollar except against the yen because of the repatriation of capital to the US.
Derek, always good to talk to you. Thanks very much for your time. Derek Kowalczyk, Chief Investment Strategist with CFC.